Hi guys, welcome to Market Buzz. Today we are going to talk about the US bond market, the Chinese bond market, and its default rates. We are also going to talk about the corporate debt around the world and also about tightening of monetary policy by the US. So let's get into it. Junk bonds rally pulls yield below inflation. Investors are piling into debt from riskier companies seeking extra yield amid ultra low interest rates. Investors' headlong embrace of risk passed a new milestone in recent sessions. The return that investors received from investing in the riskiest US companies fell below inflation. A rally in corporate debt rated below investment grade has pushed yields to record low around 4.54% according to ICE Bank of America data, while consumer price index rose 5% in May compared with year earlier. That marks the first time on record junk bond yields have dropped below the rate of inflation, according to Bespoke Investment Group. The move upends the conventional logic of investing in bonds, which are typically priced for protecting investors' money. Junk rated companies include those most likely to miss interest payments or go bankrupt. Buying bonds that yield less than inflation means locking in a loss. Now, the chart here clearly showcases that the junk bond yields minus the consumer price index. It has gone negative for the first time. It hasn't even gone negative during the financial crisis. Gennady Goldberg, US rates strategist at TD Securities, said the investor indicates investors are chasing returns far and wide in a low rate environment, even in riskier places. This is a function of too much cash in the system and too few attractive assets for investors to put their cash into, he said. The Federal Reserve moves to slash interest rates, buy corporate debt, and inject cash into the financial system helped fuel the economy. Now, a reopening economy and investors' demand for bond have spurred a wave of issuance. Companies, including retailer Victoria's Secret and radio broadcaster SiriusXM Holdings, have sold nearly $300 billion worth of high yield debt this year through June, according to Dealogic. That's more than 40% ahead of last year's pace. The issuance is now meeting increased demand from investors. US high yield funds report a net inflow of $893 million for 2021 as of June 30, according to data from Lipper. Some worry investors aren't receiving enough compensation to account for the additional risk they take on buying junk bonds. The average extra yield or spread investors demand to hold speculative grade debt instead of US Treasury was 2.62 percent points as of July 6th, according to Bloomberg Barclays data. That is down from more than 10 percentage points in March 2020. John Abendroth, a portfolio manager at Neuberger Berman, said while opportunities still abound, investors need to trend carefully at current levels. There is little room for error. There is yield to capture no matter how inflation persists and what changes in the rates landscape occur. Rating firms downgraded debt from companies including Kraft Heinz, Ford Motor Corp, and Occidental Petroleum early in the pandemic, moves many expect will soon be reversed. After record downgrades last year, Citigroup analysts expect around $200 billion worth of junk bonds to become investment grade through 2022 as the recovery continues and the rates remain low. Adding to a relatively rosy picture, the US distressed ratio, the proportion of speculative grade bonds yielding at least 10 percentage points more than treasuries, fell to 2.62% as of May 17th, its lowest level since October 2007 according to S&P Global Ratings. China bond market defaults are not the sign of a debt crisis but the growing pain of a more sustainable credit system. Concerns about the potential for a debt crisis in China grew towards the end of the year as state owned firms began to join private companies in failing to meet their obligations in the bond market. These fears are understandable in a country where bank lending to the private sector alone has soared to over 160% of gross domestic product. What we are witnessing are the growing pains of a more disciplined credit market, not a system on the edge of collapse, argues Gordon Crosby Walsh, CEO of Asia at Equities First. More credit discipline will benefit the economy over the long run, but lending conditions may be tighter in the near term. Chinese corporate borrowers defaulted on a record $25 billion of debt in 2020. These defaults include several state-owned enterprises such as Yongcheng Coal and Electric Holding Group, which would have been unthinkable in previous years. There is a wall of corporate debt about to mature, some 7.1 trillion RMB, that is equivalent to $1.1 trillion of domestic bonds, and 104 billion of offshore bonds are due in 2021. At the same time, local government borrowing rose by an equivalent of $565 billion in the first half of last year, according to JP Morgan. That is driving market expectations that local government financing vehicles will also default on their debts in 2021. The government has recognized that its domestic credit markets had run out of control since the massive fiscal and monetary expansion that followed the global financial crisis in 2008 and 2009. It is now taking painful but necessary actions. As corporate debt grew in the wake of that crisis, so did China's shadow banking system of so called wealth management products, entrusted loans, peer to peer loans, and other forms of financing. According to the China Banking and Insurance Regulatory Commission, this sector has swelled to have assets worth $12.9 trillion in 2019. In the China bond market, opacity was increased by inflated ratings that made credit differentiation much harder. Two-thirds of bonds rated by China's local agencies have a AAA or a AA plus rating, including those issued by Yongcheng Coal. Defaults by state-owned firms are a harsh medicine for investors that have long believed in an implicit government guarantee for such debts. Defaults by large companies that could have been much more destabilizing have also been avoided. China Evergrande Group, which was the world's most indebted property developer with borrowings of nearly $120 billion last year, was able last September to secure $4.6 billion of funding from government-linked investors that averted this kind of scenario. Policymakers have strengthened financing rules for real estate developers like Evergrande, promised a zero-tolerance approach to abuses in China bond market, made a credit rating firm compensate investors in defaulted bonds, and drafted stricter regulations for its large fintech companies, which have also become major facilitators of loans. The People's Bank of China has said it will pursue a flexible, targeted, and appropriate monetary policy that supports the country's recovery from the impacts of the pandemic. According to Reuters survey of economists, China's banks are estimated to have made a record $542.6 billion of loans in January. Once the initial shock caused by defaults and tougher regulations have been overcome, more disciplined credit markets and effective financial regulation will be better able to support sustainable growth over the long term. There will be significant drives of demand for capital, including refinancing that 1 trillion plus of debt that comes due in 2021 and China investment opportunities as the country's economy recovery gathers momentum. One thing that we clearly understand from this is that the main base for the financial crisis in 2008 was because of defaults. China is in a dire state of crisis with immense corporate defaults, and the world cannot bear the burden of China going into a financial crisis as China controls major portion of the global supply chain. This effect will worsen the current situation. Let's see what the official of China Central Bank has to say about this. China should guide rates lower to support growth, former central bank official says. China should guide market interest rates lower to support economic growth and ease funding pressure on local governments, a former central bank official said, adding to the debate over whether Chinese and US monetary policy will diverge further. Reasonable rate cuts also would help create space for the People's Bank of China to tighten policy if needed in the future in order to cope with an expected weakening in the yuan, Sheng Chong, former head of statistics at the PBOC, said in a column published late on Tuesday on Sina Finance. He also said that it's necessary to keep liquidity reasonable and sufficient and guide the rational and moderate decrease of market interest rates. He also said that policy tightening in the future will help ease depreciation pressure on the yuan caused by rising capital outflows from China once the US Federal Reserve starts to tighten policy from emergency pandemic levels. The Fed surprised investors last month by signaling it could start raising interest rates in 2023 or even next year earlier than expected, as the US economy recovers. Some other global central banks have already started normalizing policy. Chinese officials, however, have pledged to make no sharp policy U-turns, and markets expect key rates will be kept unchanged through at least this year. So, one thing you need to understand is that the defaults are increasing, and the central bank official wants the interest rate to be kept as low as possible because they want to increase the growth. So, this is opposite of what is happening, and this is very problematic. Now, the next thing we are going to talk about is global corporate debt. 75 trillion global corporate debt, a bubble, UNCTAD. As per the UNCTAD report, the volume of corporate debt and its quality is the cause for concern as it has deteriorated significantly since the global financial crisis in 2007-8. Since the global financial crisis in 2007-2008, the debt obligations of non-financial corporates have increased sharply that threatens to undermine wider debt sustainability. According to a UNCTAD report, corporate debt bubble might explode and cause another global financial crisis, especially in the post-COVID-19 economy when many companies will face heightened financial stress. It said that the most immediate areas of concern lie in the shadow banking system that has been ignored by the post 2010 financial regulations. As per the Organization for Economic Cooperation and Development, estimates since 2008, non financial corporations worldwide issued about $1.8 trillion in new bonds each year, nearly double that in 7 years preceding the GFC. At the end of 2019, the outstanding global stock of non financial corporate bonds was at an all time high of $13.5 trillion, twice what non financial corporations owed in 2008. If one adds to this what non financial corporations owe to banks and other creditors, their indebtedness comes to $75 trillion globally, up from $45 trillion in 2008, said a UN Conference on Trade and Development report. Next thing we are going to talk about is the Fed minutes, latest Fed minutes. Fed officials kept a patient tone in terms of tightening monetary policy, minutes show. Fed officials at their most recent meeting talked about reducing asset purchases but also expressed the need for patience. Some members noted the faster progress of the economic recovery, though the committee overall said the conditions have not met the substantial further progress benchmark to start tightening policy. The meeting summary also reiterated the Fed's view that while inflation has been rising faster than they expect, they see the current trend as transitory. The Federal Open Market Committee's June 15th-16th meeting summary provided only a few glimpses into talks about when the central bank should begin reducing the pace of its bond purchases. Most members agreed, according to the minutes, that the economy had yet to meet the substantial further progress benchmark the Fed has set out for any significant shifts in policy. While the document noted that some officials saw tapering condition to be met somewhat earlier than they had anticipated, others said the FOMC should be patient in assessing progress towards its goals and in announcing changes to its plans for asset purchases. In particular, there seems to be only limited support for beginning to taper the monthly asset purchases anytime soon. The Federal Reserve Policymaking Group kept its benchmark rate anchored in a range between 0 to 0.25%. As things stand now, the Fed is buying at least $80 billion worth of treasuries and $40 billion of mortgage backed securities. But at his post meeting news conference, Chairman Jerome Powell indicated that committee members had held their first discussion about reducing the pace of bond purchases the central bank makes each month. Now look at the chart, everyone. This is the total assets of the Fed in the balance sheet of the Fed, and this is the official data coming directly from the Federal Reserve systems. Last year, the balance sheet of the Fed during the beginning of the pandemic was at $4.2 trillion. But within a year or so, this balance sheet has increased to $8.1 trillion. Within this 1 year, the Fed has pumped in $4 trillion worth of cash into the system by buying all these treasuries and mortgage backed securities. So you need to understand that the amount of liquidity in the market is at an all time high. If you like the amount of information provided, please like this video, share, comment, and subscribe to my channel.